Hello, Dave Boucher here. I'm going to talk about in this presentation is investing in medical devices. So we're working for an investment group that was putting up money to invest or buy a medical company and that sold different types of medical products and devices. Basically, this company was selling advanced medical systems for treatment of diabetes and also sold minimal invasive tools necessary for the treatment of coronary and peripheral vascular disease. So the investment company itself was acquiring capital stock in entities of this medical product company. And what this is going to explain is the principal terms of the proposal and how the numbers, financial terms came about. So basically the valuation we first did was we found a proposed valuation of being $21 million, with the value of the company being $20.5 million itself. The valuation of the actual company would have to have at least $4.5 million at the closing, which basically is all the assets. And then the transaction obviously is $20.5 million, which is comprising of senior convertible preferred stock and convertible secured note that would be later determined by us, the investment group, and the purchaser. And then due diligence, obviously, we would have to have access to the books, records, management projections, which I'm going to talk about because we got that, and access to customer suppliers, review of tax, legal, and other similar accounting information. And then we're also going to show some of the past audited financial statements, which will be acquired for from the previous past years. The escrow is $3 million, which we placed in escrow to secure this indemnification obligation, with $1 million to be released 6 months after the closing itself. So the products, as mentioned earlier, had to have a pricing, which the pricing range, $25,000 on a lower end device to $500,000 for and up, obviously, but the average range is about $500,000 for a higher end device. So the financial status of the company at the valuation purpose, as mentioned, was 15 to 25 million, with the target at the raise being up to 15 million. So the investor groups that have put money in, were like this P venture partner had put in 9 million and then L with 4 million, but on the deal itself, they agreed to do 19 million of it. Yeah, that's after the current. But we had to have, obviously new partners, which on the third round, which we were then purchasing in, was the 30 million on both what they did on the deal and then what they were going to be doing down the road at the life of the company. So, the financing history was just more of a breakdown of dates. I didn't include them all, but this, just showing a 2.8 on, a single first quarter transaction. So, on the financial summary then, what we're projecting out first year, second year, third year, fourth year of the deal, the revenue is going to go up from 1.6 million in the second year and 16.9 in the third year, with the current burn rate then to approximately about 550,000 a month. So to put some of the financial terms better explained, we had to do some type of sensitivity analysis for the medical device company. So we came up with a base case and a conservative case. With the base case, we had to have how many deals we're going to sign per month. So we decided on 7 for the first year, 8 for the second year, and third for the 10 year, and so on. With the average deal size being about 150,000 for each individual devices that they're totaling up to sell for each company. And then the price compression was just going to be 5% for the base case, with 8% being for the conservative case. But on the other hand, that conservative case, we're saying it's going to go up from 100 to 115 to 130 for the client base itself, instead of just being a gradual same rate. And then we had to have some assumptions. These more financial assumptions, because we mentioned earlier that how many deals you're going to sign per month. This is obviously per quarter. So we're projecting out each future projection as it goes along for what you're going to sign per quarter. And then this is some of the pricing assumptions. They say a certain device that they're selling, is 350, and then 2,500 was individual client itself that it was agreeing to buy at that, within that first quarter itself, how much they're putting in of the overall purchase price. So then we went down to do returns assumptions to see how much we were going to project out to see what we're going to get. We just decided that higher end returns at the beginning with lower end on the assumptions to be projected toward the future. And for the debt financing, this is another important point I want to point out is you had to have a principal amount at $450,000, but interest rate was 10%, at 36 months. But then the interest rate in the future is going to be, down to 8 as the years grew on. For each device, though itself, you're going to have a 10% also interest rate. And then we had to have project out some revenue assumptions. So, as we mentioned earlier, we projected the deals per month, like say 3 for the individual month for a certain type of product to be trained on, not each individual, the whole total devices that I showed on the first page. And then the percentage of the deals, we had to say that we're going to get, for the first quarter, for the second quarter, 20%, with it gradually growing each quarter for each device. So, say device 1 was a smaller device, while device 2 was more of a needed device. So you needed the product. So that's why we have 100% there itself. With the pricing and deal assumptions, then the device 1 had to have $15,000 as the, just a set price that we're estimating out for that first device. But then, each device had a different product number, so it was gaining because you were selling more as the years progressed and the quarters progressed. As were the current clients per deal, as you can see, each quarter, each year progresses out, the devices were selling higher, so you're going to get more clients, and that's why you increase the client pricing itself too. So then our total net books, because what we're trying to do is we're trying to find the discount and the maintenance. So the total net bookings of the devices, and we're coming up for a total each month. As you can see, it was gaining all the way up to, say the end of year 1, the beginning first quarter. You're going to have that as your total, $431,250. So then we had to have a working capital assumption itself. So on this, we always had to do what you're going to see in receivables and payables and see what's going to come in and out each month. So we just, set an average of 40 receivable days outstanding and 30 days outstanding. With your debt or percent of revenue is 1.5%. And then the working capital overall, when you're going through and you do your receivable numbers and your accounts payables, we had obviously here as a negative working capital. As the growth, even with the growth itself, with the receivables coming in, and this is only the first year, which is very common to have that negative side on that first year of turning over the product. So then on the cash side itself, though, it was changed quite often each month to say down the road, as you can see, the cash was still stagnant to be the same, ranging from $100,000 to $250,000 itself. On the next, I'm going to show is the debt interest for the device on the overall analysis. You see your debt schedule. It's going to be relatively gaining from a higher end in each month, but it was leveling out as you move on. So in the cash balance, then for say the first month, you're going to see it $3,675,000, but that's relatively small compared to here. You get your $14 million, which is going to be obviously growing higher because you have these proceeds that are coming in, and then you got your funds available for debt repayment. So that's money that came in, and then you obviously have the credit line. So this is funds available that's going to be needed for the credit line. So to put some of that jargon to make a little more sense, you did a amortization schedule, based it off of that 10%, which I was talking about earlier, on that 35, 36-year month loan. So when you get down to the bottom of it, you see what the borrowings and interest payment is for the interest rate calculation. It ends up being about a payment of $6,000 a month, which is very good for the size of company that we're purchasing into. As you can see, towards the end here, it's only 136, 116, so that's a relatively decent number. And you got your statement of operations, which obviously, because this is a common stock, it was flat or pretty much stayed the same throughout the whole first year, as did the preferred stock. It for the first quarter it was the same amount, and then each quarter it grew on. The retained earnings itself ended up being, adding those two together, relatively the same, with it growing at a certain percent, but ended up being flat when you got in year two to being a little bit stagnant, more than what some of the executives wanted, because your overall margins, as you can see here, you got year 1, year 2, year 3, and year 4 on the revenue side. The margins, or the net margin itself, was largely negative in the first year, but as you can see, as the projections, because the product was growing and gaining strength to take care of that debt, ended up being positive year out. And then we stopped there because that's how we wanted to show when we're going to turn into the positive side of the overall operation. Thanks. That's the end of this presentation.